There's no question that a 100% stock portfolio will do better in the long run. I mean, that's just the numbers. As stocks will return over the long run, not every 25-year period, but probably 3 out of 4, stocks will return more than bonds. They will be the highest returning investment because they have a higher risk.
And that's the key. Understanding that over the long term, stocks offer the highest potential returns. So if you've got $50,000 saved up, maybe just sitting in your account, collecting a tiny bit of interest, or maybe you've been holding off, unsure about where to invest it, I get it. It's easy to feel overwhelmed with all the investment choices out there. You want that money to grow, to build wealth, and eventually give you the kind of financial freedom you've dreamed of. But let's face it, the options can be confusing, and no one wants to gamble their hard-earned cash on a risky move. But what if there was a formula, a simple 5-step blueprint that could transform your $50,000 into a thriving investment portfolio? That's where index funds come in, and not just any. Vanguard's top-performing index funds. These funds have a proven track record of stability and growth, offering a straightforward way to put your $50K to work wisely. In this video, I'll walk you through the 5 best Vanguard index funds and how each can help grow your investment. I'll show you the potential returns you could see from each of these funds and why they make sense for anyone looking to build a solid financial future. And in the end, I'll show you a Vanguard fund with the potential to turn your $50,000 into a $10 million portfolio. Before we jump into the funds, it's key to understand the mind behind this approach, Jack Bogle. Bogle, who founded Vanguard in 1975, was a revolutionary. His simple idea was to cut costs, avoid middlemen, and focus on index funds that track the entire market, making investing accessible to everyone. Bogle believed in 3 core principles: simplicity, low costs, and long-term focus. First, he advocated for broad diversification, owning small parts of the entire market to spread risk and capture overall growth. Second, he pushed for minimizing fees, as high costs quietly erode returns over time. Lastly, he emphasized the advantage of long-term investing, saying, "Time is your friend, impulse is your enemy." By letting investments grow over decades, you trigger what we call a snowball effect in finance. With that in mind, let's kick things off with VIPX, or Vanguard Institutional Total Stock Market Index Fund Institutional Plus Shares. If you've never heard of it before, don't worry, this one's a classic. VIPX is basically your all-in-one ticket to owning the entire US stock market. I'm talking about everything, from the biggest tech giants like Apple and Microsoft to those smaller companies that might just be the next big thing. Now, why does this matter? Well, VIPX is designed to give you exposure across the board. Large, mid, and small cap stocks are all part of the mix. Think of it as a one-size-fits-all solution that spreads your money around the entire US market. When you invest in VIPX, you're actually buying into a massive collection, over 3,000 different stocks. And yes, big dogs like Apple, Alphabet, Google, and Microsoft are in there. But you're also investing in a ton of smaller companies that you probably haven't heard of. These smaller players might not be making headlines today, but they could be the ones driving growth tomorrow. So, why is VIPX a solid choice? It lines up perfectly with Jack Bogle's Keep It Simple philosophy. It's a set it and forget it kind of deal. You invest, and then you let it grow while you get on with your life. No need for constant monitoring or trying to time the market. It's passive, simple, and fits right into Bogle's vision of long-term investing. Let's look at how it's performed. Over the past decade, VIPX has already been a steady performer. We're talking about an average share price appreciation of around 8.06%, and the average dividend growth rate is sitting at 9.58%. And with a current dividend yield of 2.01%, you're not just banking on the stock prices going up, you're also getting paid along the way. Historically, even when the market has had its ups and downs, because let's face it, the market is a roller coaster, VIPX has bounced back and shown consistent growth. It's a classic example of why diversification works. When some stocks in the fund take a hit, others can help balance things out, keeping you on track for steady growth. Now let's put some numbers to this. If you invest $50,000 into VIPX today, what could you expect? Based on how it's performed in the past, your investment could grow to about $55,035 in 1 year. If you hang on there for 10 years, that $50K could grow into around $132,000. That's more than double your money. And here's where things get exciting. If you stay invested for 20 years, you're looking at around $360,000. If you've got the patience to wait 30 years, your investment could potentially skyrocket to over $1 million. By that 30-year mark, you could be earning roughly $28,625 in annual dividends. In total, the value added to your investment would be around $972,221, with a big chunk, $722,884, coming from the increase in stock prices, and another $250,000 from those reinvested dividends. Next on my list is the Vanguard Dividend Appreciation Index Fund Admiral Shares, ticker symbol VDADX. VDADX focuses on companies with a solid history of increasing their dividends over time. In simple terms, these are the kinds of companies that have been around for the tough economic storms. The companies you'll find in VDADX are big, stable, and frankly, pretty reliable. I'm talking about household names like Microsoft, Johnson & Johnson, and Procter & Gamble. These are the kinds of companies that have proven they can weather economic storms and still come out on top. When you invest in VDADX, you're not betting on some hot new tech startup. You're putting your money in businesses that have been around. They know what they're doing and have a track record of rewarding their shareholders year after year. What's great about this fund is that it targets the large cap segment of the market, which means it focuses on big companies with a lot of stability. Large cap stocks are generally less volatile than smaller ones, making them a safer bet, especially if you're looking for steady growth and consistent payouts. As for the performance over the past decade, this index fund has shown an average share price appreciation of about 9.79%. On top of that, it had an average dividend growth rate of 10.33%. The current yield sits at 1.68%, which might not sound like much, but remember, this yield is growing as the companies in the fund continue to increase their payouts. Historically, this approach has been a winner for long-term investors who want growth and income. When the market hits rough patches, these companies have kept their dividends coming, showing why they're a solid addition to any portfolio. If you decide to put $50,000 into VDADX, what could that mean in the future? If we base it on the past performance after 1 year, your investment might grow to about $55,735. Hang in there for 10 years and that could turn into $150,000. That's almost triple your money. If you're patient enough to stay invested for 20 years, you're looking at around $445,000. And if you've got that endurance to let it ride for 30 years, your investment could potentially reach $1.3 million. You'll also be bringing in about $23,700 in annual dividends. The total value added over these 30 years would be around $1.29 million, with a massive chunk, $1,088,000, coming from the rise in stock prices, and another $200,000 from those dividends you reinvested. It's the classic let your money work for you scenario, showing the power of compounding in action. If you think these are good returns, wait for the upcoming index funds. There are funds that can double the return in the same time. In the end, I'll show you a Vanguard fund with the potential to turn that $50K into a $10 million portfolio. At number 3, I have Vanguard Consumer Discretionary Index Fund Admiral Shares, or VCDAX for short. This one's all about the consumer discretionary sector. If you're not familiar with the term consumer discretionary, it's basically a fancy way of saying this fund invests in companies that make stuff people buy when they've got extra cash to spend. Things like retail, automotive, entertainment, and other luxury goods. It's everything people want when times are good and they've got some disposable income to play with. This fund focuses on a market segment that includes some of the biggest names in the game, like Amazon, Tesla, Home Depot, companies that are essentially household names and often the first stop when people think about spending money. These businesses are leaders in their industries, and when the economy is strong, they tend to perform really well because people are more willing to spend on things beyond just the basics. So why is VCDAX a good investment? Well, if you believe in the cyclical nature of the economy, meaning that the economy has its ups and downs, this fund can be a smart play. During economic expansions, consumer discretionary stocks usually see big gains because people are spending more. The companies in this fund are positioned to take advantage of those good times, which means your investment could see substantial growth when the company is on the upswing. Now let's dig into how the index fund has performed over the past decade. On average, it's seen a share price appreciation of about 11.99%, which is pretty solid. The dividend yield, however, is on the lower side at 0.77%. But here's the thing. Consumer discretionary companies often prioritize growth over paying high dividends. They reinvest their profits to expand and innovate, which can lead to higher share prices over time. The average dividend growth rate has been 5.46%, so while you're not getting a huge income from dividends right away, there's potential for them to grow as these companies continue to succeed. So let's run the numbers. If you put your $50,000 into VCDAX, based on historical performance, after 1 year, your investment could grow to around $56,380. In 10 years, that could grow to roughly $163,000. If you stay invested for 20 years, you'll be looking at around $520,000. And if you're in it for the long haul, say those 30 years, you could potentially see your investment grow to a solid $1.6 million. The total value added to your investment over 30 years could be around $1,586,686. Of that, $1,560,775 would come from the growth in share prices, and another $25,911 would come from reinvested dividends. Now we move on to my top 2 Vanguard index funds. At number 2, I have Vanguard Russell 1000 Growth Index Fund Institutional Shares, or VRGWX for short. If you're someone who's all about growth and looking for big, high-potential companies, this fund is right up your alley. This index fund is all about capturing the performance of large-cap growth stocks within the Russell 1000 index. In plain English, it's investing in big companies that are growing fast, usually because they're innovating or leading in their industries. If you love names like Apple or Alphabet, which is Google's parent company, or Visa, well, you'll be pleased to know that they're major players in this fund. The idea behind this index fund is simple. It targets companies that are expected to grow faster than the average. These are businesses that are typically in tech, healthcare, or finance, industries that are expanding rapidly and reshaping the future. Now, what makes VRGWX a solid pick for those chasing growth? For one, it's diversified across sectors that are all about innovation. You've got tech giants like Apple and Microsoft leading the charge, but it also includes healthcare firms and financial services that are evolving and expanding. These companies are often leaders because they know how to adapt, grow, or seize new opportunities. Looking at its historical performance, VRGWX has been a strong performer. Over the past decade, it's seen an average share price appreciation of 15.13%. It has a current dividend yield of only 0.62%. This is not a fund where you'll be looking for dividends, but that's not really the point. The focus here is on capital appreciation. Basically, the idea that your shares will grow in value significantly over time. The average dividend growth rate is about 7.46%, which is still not huge, but it adds a little on top. So let's break down what this all means. If you decide to invest $50,000 into VRGWX, if we go 1 year, your investment could grow to about $57,875. In 10 years, you could see that $50,000 grow into approximately $212,000. That's more than 4 times your initial investment. Take it to 20 years, and you're potentially looking at around $885,000. And if you're all about playing the long game, holding on to it for 30 years could see your investment grow to a massive $3.6 million. The total value added over those 30 years would be around $3,599,998. Of that, a whopping $3,572,814 would come from the increase in stock prices, and only $27,184 would come from those reinvested dividends. And now, finally topping my list at number 1 is the Vanguard Information Technology Index Fund Admiral Shares, or VIPX for short. This index fund is all about the tech sector, from software giants to hardware makers and everything in between. VIPX gives you a piece of the market that's shaping the future of almost every industry. This fund is packed with big names. Think Apple, Microsoft, Nvidia. These are the companies leading the charge in innovation, and they are not just playing it safe. They're actively disrupting and setting new standards. Tech is one of the most dynamic sectors, and companies within it often have higher growth potential compared to other industries. Sure, it's more volatile. Tech stocks can rise and fall quickly, but if you're comfortable with a bit of a roller coaster ride, the rewards can be substantial. The technology sector is always expanding, and the companies in this fund are positioned to capitalize on everything from digital transformation to advancements in semiconductor technology. Let's look at how the index fund has performed historically. Over the past decade, this fund has seen an average share price appreciation of an impressive 19.27%. That's pretty substantial growth rate, especially when you consider that the current dividend yield is only 0.63%. It's clear that VIPX is less about dividend income and more about seeing the value of your investment skyrocket as these tech giants grow. Let's put this into perspective with some numbers. If you invested $50,000 into VIPX today, what might it look like in the future? After just 1 year, your investment could potentially grow to around $59,950. But it gets even better if you hold on. In 10 years, that $50K could balloon to around $300,000. Stay invested for 20 years, and you're looking at around $1.7 million. And if you're in it for that long haul, over 30 years, your investment could potentially reach a jaw-dropping $10,340,224. So, the total value added to your investment over those 30 years would be around $10,290,224. Of that, a massive $10,265,000 would come from capital appreciation, and another $24,000 would be from those reinvested dividends. Want to know about the super undervalued Chinese stocks that fall within Warren Buffett's value principle? Check the video to find out now.